Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 to 40 minutes or so. Really busy week of events to look back on and actually to look forward to, of course. We'll first just review last week's main data points, which were around the UK, really. So the UK jobs data, UK CPI data. And also then we'll look at some of the US strong data that continues to feed through into the economy, US retail sales amongst them. We'll then look at all the key events for this week, which include the just released actually PMIs out of the Eurozone and the UK, as well as them reviewing a big review of the ECB meeting and the Bank of Canada central bank meetings, as well as then hopefully touching upon some of the US data as well coming out, GDP, that is some core PCE inflation data as well on Friday out of the US. Yes, we'll wrap it up, hopefully, if we have time, with a brief look at the Aussie inflation data, which is out overnight later on today. Okay, firstly, we'll just check out how markets are shaping up currently. Just bear with me 1 second. As firstly, I just want to check out where markets are currently, as I say. Really interesting at the moment, obviously, with everything going on with the geopolitical issues in the Middle East. We have a lot of macro data as well, those central bank meetings, and then just these big moves in the bond markets, which really are grabbing the attention of everyone and causing moves in the dollar, as well as stock markets, of course. Here you can just see, I'll just double check, you can see this chart, which is the 10-year US Treasury yield chart. Just before we get to that, actually, just a general overview of how markets are shaping up on Tuesday today. US equity futures, actually just checking, they're trading slightly firmer overnight after seeing the S&P actually close at the lowest level since May yesterday. Really nervous kind of trading activity driven by, as I say, these big moves in the US bond markets. The US 10-year yield, Treasury yield, that is, hit 5% on Monday before then pulling back. And on this, you can see this monthly chart, actually, and I just want to show you where we are currently. The dotted line, thick dotted line there, is the 5% level. And you can see we have to go back to sort of 2007, so 16-year highs. We're very close to that high, actually, you could see was at 5.28%. So you just get a sense of where we are historically, and going back, way back 16 years, as I say, above then we're way back to sort of the start of the century even. So really big historical moves now in the US bond market. And if we just pull back to the daily, you can see how we just sort of tap that. You can see here, I just make that somewhat bigger. Yeah, you can see we pushed above the 5% to 5.02% on the 10-year Treasury, and then had a sharp reversal. Really interesting, really volatile moves in this US 10-year Treasury yield, which is really a global proxy for borrowing costs. So as I say, yeah, 5.02 we got to before then closing at 4.85. By all accounts, one big investor said that they had closed their short position. That is Bill Ackman, basically said to be unwinding bets against long-term US Treasuries, essentially due to what he said was too much risk in the world. And interesting, really, selling position pressure. So we did move lower, but remember, yields move in the opposite direction to prices. So selling pressure still persists, really. It seems like this morning, and the bond sell-off really due to some of the weak PMI data we've seen released earlier today out of the Eurozone and the UK. Obviously, investors also eyeing up other US data later on this week, including the GDP, as I mentioned, and the PCE deflator on Friday. big otherwise big events for this week are of course in equities, and earnings from a handful of big tech names, including today after the US closed, Microsoft and Alphabet. Asian stocks, actually, they traded mixed overnight. The dollar softer in response to the bond yield retreat, really. Crude oil edging higher following Monday's drop, while gold kind of continues to stabilize after its recent surge. It had continued to stabilize, but it has dropped slightly now with the dollar pushing higher, actually. We can see this is now the gold chart, daily gold chart. You can see this big ramp up from sort of 1820 support up to very close to 2000, so 1997, that high from last Friday. Real spike higher, though, you can see, and we closed, well, still high on the day on Friday, but much lower than the highs that were at 1997. And then since then, so yesterday and today, this move lower now in gold. Really, if you just think that it was bid strongly due to those tensions in the Middle East, really keeping a demand for safe haven assets, including obviously bullion and gold, of course. Then the Treasury yield softening, especially the 2-year softening as well. That's really helped gold, of course, with those declining yields. Gold, of course, being a non-yielding asset. Slightly turned now this today, certainly on the back of that weak data out of the Eurozone, the dollar picking up and causing some profit taking in gold, of course. We're still elevated. You can see we're still above that September high at 1953. So that'll be probably an interesting initial support level before then that spike at 1947. And then you've got a couple of long-term moving averages, the 200-day moving average at 1931 there, that black line, and then the grey line at 1922. That's the 100-day moving average, which tallies with this sort of consolidation in mid-October, the middle of this month. So that's gold. Interesting turnaround, just on the turnaround in the dollar, really, and yields kind of stabilizing after that top above 5% was then pulled back to around 4.85, and we're now at 4.87%. For equities, then let's just touch on those. Futures closed lower yesterday, but recovered really from an ugly decline, really on the back of that move in the bond market. Interesting. I'm just going to pull up the S&P 500 chart here, and you can see. Yeah, we've got a couple of fib levels in here. This is the weekly chart, but really it's a big week for equities. The busiest week, actually, in terms of companies posting corporate results. Almost $16 trillion worth of firms posting their results this week. If I just show you a really good chart from John Authors from Bloomberg, who just... You can see, the busiest week so far, almost $16 trillion worth of firms posting corporate results this week. That's over 164 companies, comprising around 40% of the market cap of the S&P 500. So you can see there that this week, much bigger than any other week. It seems headline reports, of course, as I said, Microsoft, Alphabet, and Amazon. Amazon on Thursday after the close, Google and Microsoft today after the close, and Meta after the close tomorrow, Wednesday. Just checking the calendar there. Next week, just in comparison, we get 157 companies reporting. That amounts to around 23.5% of the benchmarks. The benchmark gauges market cap, and that will be led by Apple next week. So a really important week, just as a general overview, even beyond just the size of the companies reporting. It's really what they may mean for sentiment around the market. That's really crucial when you have obviously the biggest, the top companies in the world potentially saying things are slowing down, potentially saying we're possibly in for a slower season or a forward guidance, certainly then that all obviously extends into other companies which don't have the same advantages. And let's not forget, of course, these major companies are also customers of a lot of companies downstream. So that's why these sort of handful of tech giants and the Magnificent Seven really, as you know, we've called them, a lot of people calling them that moniker, really encompassing those mega cap tech stocks which have led the indices so far this year, driven the indices higher, and then potentially that's why there's so much focus on them this week and next week. Just when we look at earnings expectations, actually across sectors, it is clear that it is only the US tech sector that is seeing rising earnings expectations, and that naturally then lifts the bar for investors going into tonight's earnings releases. So firstly, we have Microsoft, actually. Just bear with me 1 second, because I just want to pull up what we're seeing first of all. But you can see, yeah, that chart just before I get to actually the S&P, the wider chart. Just going into some of the results. So firstly, we have, as I said, Microsoft and Alphabet out overnight tonight. Microsoft, along with, well, the so-called Magnificent Seven, as I just said, they've seen strong gains since the lows of October last year. Microsoft shares actually hit a new record high back in July after the company reported a strong set of Q4 and annual numbers. Q4 revenue actually increased 8%, a new record for an individual quarter, and that pushed up total revenue to above $211 billion. We had a strong performance from the Intelligent Cloud division, while cloud services revenue from commercial and consumer products also saw strong gains. On the downside, this is obviously previously we had revenue from personal computing fall 4%, and really as well, devices revenue fell some 20%. So going forward, hopes are high that the purchase of Activision Blizzard will now go ahead after the deal was approved by UK regulators. The shares, Microsoft shares that is, have slipped back a touch from those July peaks amid concerns that revenue growth in Azure might continue or might slow to between 25-26% in Q1. And that compares with sort of 42% last year, 48% the year before. So just watch out for that, as well as the move into obviously OpenAI, which will be looked at, of course, with AI a key focus for markets generally. If we just look at if we just pull up the Microsoft chart, actually, just to focus on that first of all, just bear with me 1 second, and I get that for you, which is here. So you can see that high that we talked about at, well, 366 I've got here. Just checking that is right. But anyway, yeah, spike high really from mid-July, and then we sort of drifted lower, that you can see there. This is the weekly chart. If we would just go to the daily chart, you can see we're just oscillating. Yeah, sort of range trading really, if you want to talk about it, between sort of 310 and sort of 340 or so. So looks like 340 and just below is decent resistance really. And then, yeah, as I say, major support around 310. So really we'd have to break this high here at 336 before then getting towards sort of 340 if we do get a strong set of results. And you, yeah, and then if we do break that, we're moving up towards these highs here around 350 and above. Otherwise, a break lower below the 50-day moving average, then we'll certainly roll over and move down towards 320, possibly 310. But that would mean really shocking results and move the market, of course. Just on Google, just bear with me 1 second while I just pull up just before I pull up the chart, actually, Google itself. Which I'll just bear with me 1 second while I just get rid of this. Google itself, well, yeah, that'll be interesting. A set of results for sure. They also, of course, along with all these big mega cap tech stocks, really had strong gains, rising more than 50% actually Google this year. Not as much as some, of course, Meta above 150% this year. But Alphabet, yeah, up more than 50% this year. Since the company reported its Q2 results, they kind of maintained a steady upwards momentum, rising to 18-month highs last month. Q2 total revenue rose by 7%, strong performance from the Google search. Of course, YouTube as well, that revenue increased up from a weak Q1. So one of the main reasons for underperformance in Q1 actually generally was in relation to a severance cost for the 12,000 job losses. Q2, really, the company set aside further $69 million in relation to, well, optimizing office space actually on top of around 500 million set aside in Q1. So for Q3, total revenue forecast to increase to 75.5 billion. Profits are expected to come in at $1.45 per share. Okay, if we just roll over to the chart actually of Google, just bear with me 1 second. I just should have put that out earlier, really. Which you can see here. Yeah, so we did top out that 18-month high at 142.38, and we just rolled over. Interesting, now we're at the 50-day moving average at 135.23. So that should, you can see, has offered decent also support around that level previously. So see whether that holds. As I say, the high otherwise 142.38. If we just pull back, then you can see where we are historically around these highs from back in March last year. Otherwise, then we get up with strong results up to sort of 150, and that's will be strong resistance in those previous highs from, well, 2021, end of 2021, and the spike high in January 2022 was at 152.10. Okay, that's Google and stocks. If we just then go just to the broader indices as well. Just bear with me 1 second. This is the weekly chart. I've still kept in that long-term trend line support, really, and we've just sort of broken down through it last week. You can see we're now sort of around the halfway point. I've kept that in here from the sort of March lows, the March rally there, halfway point at 42.11. And just below here, we've got the 100-week moving average and the 50-week moving average around sort of 41.80, 41.89. If we just go to the daily, though, is the 200-day average, moving average, which is key for a lot of people, a lot of focus around that level. We did move above it yesterday, but then closed below. And really interesting, and that's a 42.35 now, that 200-day moving average. 42.11 is the halfway point, so strong area, zone of support really around this level, 4,200 or so. If we do move down lower, then we've got the next fib level at 41.18, which is probably, yeah, the major level that we can see, because there's a bit of noise here around sort of 4,100. So interesting. If we don't keep here, then yes, we will fall lower. It looks like down towards 4,100. At the moment, futures are positive, up over 0.5%, so at 42.65 potentially the open. So as I say, strong support there. We bounce off this, then we go up to sort of 4,300, back to that long-term trend line support, which becomes resistance. But if we move above that 4,300 line, then we're back up to, yeah, this sort of 50-day moving average around 43.81. Just on the NASDAQ, you can see we're holding above that, yeah, this really strong zone of support around 14,500 or so in the NASDAQ 100. Futures pointing to a open around 14,800, which would obviously be positive, and we're bouncing then off this support level, which reinforces it. as a strong key mark of support. We've got the 50-day moving average just above 15,000 and the 100-day moving average as well, just around that level. So potentially, we're bouncing off this zone of support and moving higher with sort of 15,000, the next level of resistance. Just on the Dow, finally, we can see the 200-day moving average above at 33,829. You can see, futures just pointing to just under 0.5% move higher today. Again, we've got this sort of zone of support around just below 33,000, really, around here, and then back in sort of May time, and May time around this level as well. So if we bounce off this, again, reinforces that level of strong support with sort of 33,829, and then these highs previously mid-October highs around 34,000. That is in the Dow. Okay, let's now go to last week's main data, which encompassed a lot of UK data, especially. Firstly, the UK CPI data. You can see a nice review here of the main numbers. Fuel prices really saw the headline stick at 6.7%. That was unchanged from August, and a tenth actually higher than expected. Some way off the peak, of course, of 11.1%. That was just under a year ago, but still certainly over 3 times the Bank of England's target of 2%. The core, which obviously strips out volatile food and energy costs, that fell to 6.1%, actually also 1/10 above forecasts. Remember, it topped out at around 7.1% earlier this year in May. The MPC, the Bank of England, certainly focuses on services inflation, as that has been impacted by the tight labour market and record high wage growth. That rose 1/10 to 6.9%, but still remains below the bank's own forecast of 7.0%. Still too high, though, certainly, and probably too high for quite a few MPC members. That is what they focus on, services inflation, and still oscillating around, 6.9%. Just on the wage growth numbers, we had those the day before the CPI. They didn't really spring any nasty surprises, but they're still elevated. Average earnings eased actually to 8.1% year on year over the August quarter, down from 8.5% in July. Ex bonuses, earnings eased to 7.8% from an upwardly revised 7.9% in July. Interesting, Governor Bailey, he recently said how he was kind of puzzled by the persistent strength of pay growth, which had not really reacted to the string, of course, of 14 straight rate hikes by the bank, unlike other parts of the economy. Markets really view the break in the rising wage trend as tilting risks really against another hike before year end. Although, as I've said, wage growth still remains strong overall. It's just that the trend now is hopefully tilted down now from that strong uptrend from those record highs. And markets sort of pinning their hopes that there wasn't any sort of nasty surprises. Today, interestingly, we did have part of the jobs numbers which were delayed from last week. And we also had the latest PMI figures, really important figures. They both suggest the economy is cooling, albeit gradually. The service sector in particular actually is continuing to contract in the UK, very, very slightly faster than in September. There's also a steady easing in hiring demands in the jobs data, and a corresponding increase in unemployment over recent months. Just note that the ONS, so the Office of National Statistics, kind of made it clear that this data is becoming less reliable. Seasonal adjustments really quite hard to make. So just bear that in mind, because policymakers may do that as well. And from their perspective, really shouldn't really change the dial. All this data, then this key data we get really, which we've now got ahead of the Bank of England meeting at the start of November. They are fully expected to keep rates unchanged again in early November. Remember, the bar was set really quite high for another hike after that surprise pause in September by the Bank of England, and really the lack of any major rebound in CPI after August big downside miss is really probably quite encouraging for policymakers. And then overall falling underlying price pressures kind of remain in play, but at a gradual pace, which means rates potentially on hold now, potentially until sort of next spring, summer, when market then will focus on cuts possibly. A lot obviously depends, of course, on that wage growth downtrend continuing, and then also CPI continuing, with obviously policymakers wary of commodity and energy costs potentially rising with the Middle East conflict or not. Okay, let's just go to now cable, actually. Just bear with me 1 second. I'll just pull up that chart, which you can see still, well, just about still in the downtrend that we've been highlighting for some time now. If I just extend that and just extend that a touch, well, yeah, to there. Also, again, a bearish channel, a series of lower lows, lower highs since that top out above 131 in mid-July. We potentially look, you can see today, we're moving out of that top part of the channel there, the high at 122.88, but then the PMI struck really, and sellers have been evident, of course. People, investors buying the dollar, obviously selling the sterling as well as selling the euro. We'll look at the euro dollar chart shortly when we look at the ECB, but we're now back in the channel, which means potentially if that holds, then we're moving down again towards sort of the low 121 and then 120. Interesting whether this channel, the top side, holds. That comes after, of course, that big move, decent move yesterday, where we got up to, well, from the lows of 121.43 up to 122.58. Okay, that's cable. Let's just move now to, we'll move quickly to the US data out of last week. We had hard US macro data. Which really continued the streak of upside surprises last week. Retail sales, they grew by 0.7% month on month in September. August revised higher to 0.8%. And while sort of gasoline prices provided a modest lift to sales, remember retail sales done by volume of sales as a monetary figure. Even the control group that excludes volatile, car, gasoline, restaurants, and building materials, that grew by 0.6% month on month, with the consensus at flat, actually, for a flat reading, and the August reading was at 0.2. So really strong retail sales. And as core CPI grew by 0.3% in September, it looks like real consumption volume continued to grow. And that all suggests that the US economy has remained on a more solid footing than expected. So really important figures, these. The markets did pay note. And we also then had industrial production, which surprised to the upside. 0.3% consensus was for a flat reading, although the uptick was compensated for by a downward revision to the August data. We also had initial jobless claims, I think, again, sub 200,000, again, reinforcing the solid footing of the labour market, and that enduring more than many expect. I've just got the DXY chart up here that you can see. Just of note as well, last week we had Fed Chair Powell speak on Thursday. He kind of echoed the slightly cautious tone of his colleagues' recent speeches, really highlighting that the tightening financial conditions take some pressure off the Fed to continue hiking policy rates, and that the FOMC is proceeding carefully. He said that a few times now, so really important to note. The prepared comments were relatively brief, but they noted that additional evidence of economic strength could require more tightening, while acknowledging recent slowing in inflation and kind of easing in overall labour market tightness. So the Q&A actually sounded a little more hawkish, but all in all, it really kind of doesn't point to someone wanting to think about one last hike just yet. And indeed, the December pricing for the Fed, that paired tightening back to around 6 basis points, so about a 1 in 4 chance of a December rate hike. That is from around a 40% chance, around 10 basis points priced in before Powell spoke. So interesting change of pricing for the Fed for the December rate hike. Certainly November the 1st meeting, that is 0 chance of a Fed hike in next week actually. So yes, that was Powell's latest remarks, and of course, all his colleagues' recent speeches, similar to what he said. We now are, of course, in the blackout period for Fed speakers, so we don't hear from them at all. I guess just watch out for possibly the Fed whisperer. That's the Wall Street Journal's Nick Timiraos, who potentially may have an inside line if the Fed, the FOMC kind of don't like where markets are positioned. But at the moment, 0 chance of a November hike and around a 1 in 4 chance of a December hike now, down from around 40%, that is. You can see the DXY chart. We'll just pull that up here. Really nice ascending channel. We've just sort of broken out of it now. Although interesting, today's price action just pausing and just holding support around that sort of 38.2 fib level, around 105.38 or so. We tapped that, looks like today, yep, 105.36 the low, and we've bounced off that now. So it looks like decent support around this level, potentially moving back above 106 or so if we can hold this sort of 105.38 level. Below there, you've got the 50-day moving average of 105.20, but not much else. So if we do roll over until sort of probably these kind of levels, which would be close of the week levels, I guess. That's the DXY. Okay, let's now move on to the main events of this week. That will be, of course, the ECB meeting. If I just pull up a graphic for you with the main numbers for the ECB, which you can see here. So really consensus unanimous, really expecting ECB to stand pat on all 3 of its key rates, with markets virtually signaling 100% chance of such an outcome. The expectation for unchanged rates really has stemmed from, if you remember, the September policy statement that noted that the Governing Council now judges that rates, and I quote here, have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to the target. Since that meeting, we've had headline inflation year on year cool to 4.3% in September from 5.2%, whilst the core metric that fell to 4.5% from 5.3%. Also, then today, we've had some really important PMI data for October. That was released earlier this morning, printed at 46.5, the composite, from 47.4. That's, as I said here, a 35-month low now. We had even deeper, in even deeper contractionary territory. If you remember, 50 is the boom bust line. Below there denotes contraction, and we've had then also the services PMI data falling to a 32-month low. It's actually worth highlighting what the accompanying PMI report said. Basically, in the Eurozone, things are moving from bad to worse. They said manufacturing has been in a slump for 16 months, services for 3, and both PMI headline indices just took another hit. In addition, all sub-indices point very consistently downwards, apart from a very few exceptions. So overall, it kind of points to another lackluster quarter. And potentially we see a mild recession in the Eurozone in the second half of this year, with 2 back-to-back quarters of negative growth. So the ECB will be armed with this data, really quite negative for the Eurozone. But against that, of course, we do still have higher oil prices and continued labour market strength, which possibly will keep upside risk to inflation alive. Really, then the meeting will be all about whether the ECB gives off any clear messages of a possible hike in December or not, and whether Christine Lagarde will keep that option open for a hike in December. But yes, it'll be interesting, especially after this PMI data, whether that actually happens or not. I've put on here on hold for an extended period, and you can see, well, 4%, keeping levels, the rates at 4% are given for this meeting, but it's what the hints, any hints around December and going forward after that. It will be the first time they've kept rates unchanged since June of last year. And as I say, key will be whether they hint at another hike or not, and possibly close the door to that. And so the press conference with Christine Lagarde will be really important. In terms of commentary from the bank recently, well, Lagarde has continued to reiterate that rate is sufficiently restrictive, whilst also noting actually that there is a policy lag in the pipeline from past hikes. And even actually some of the hawks on the Governing Council, they've stated that they're kind of comfortable with the current level of interest rates. And as well, let's not forget the recent increases in Eurozone bond yields. They will act to tighten financial conditions, while then, of course, we have those geopolitical risks in the Middle East, which give reason for caution. Okay, so that is the ECB meeting. And if we just pull out the ECB, so the euro dollar chart, which I'll just get here, which was looking slightly more positive until that PMI data. You can see still got this descending channel, which I probably should take out, but it's just a really clear show of a bear channel, lower lows, lower highs series of, but we've just broken out of that. And yesterday's push higher, really interesting, got to the 50-day moving average around 106.78, that is. And even today we pushed above it to 106.94, but then that PMI data, if you can see here, after that data, bang, sellers came in and pushed prices sharply lower, although we are on the 1 hour chart as at least holding and trying to hold up here as sort of US traders come in. So that's interesting as well. 106.78 now, the 50-day moving average. Otherwise, then, well, we've sort of got levels above 107 towards sort of these highs here, mid-September highs around 107.64, 107.67 or so, the next upside level. Otherwise, we've got some long-term fib levels in here, which are going back. Let me just check. Yeah, from sort of November up to the rally, up to, the highs above 112. So the fib level there is around 106 or so. Yeah, just above 106, which should act as support as well. That's very long-term support, really, in euro dollar. Okay, next up is we'll look at the Bank of Canada. Actually, before we get to that, I just want to show you one chart which I should have showed you before, which for the ECB just shows you actually yes, the Eurozone GDP numbers shrinking, you can see, and then that composite PMI data, which has turned lower again from, as I say, from 47.4 down to 46.5, which would mean that will turn lower below that low, that recent low as well. So just a guide as to those PMIs and how they sort of tally with GDP and potentially a recession. Okay, let's move on to now the Bank of Canada meeting. Just bear with me 1 second. I'll just pull up the dollar CAD chart, which is here. And you can see, first of all, well, Bank of Canada, that is a decision on Wednesday. What was actually interestingly a 50-50 call or so on a 25 basis point rate hike only a few weeks ago, now come down to sort of 20-80 in favor of no change. So keeping rates at 5%, that really comes after those latest inflation numbers last week cooled more than expected. The growth outlook also clouded, really. Economic activity surprisingly contracted in the second quarter and flatlined in July, with activity more subdued due to previous Bank of Canada tightening. We've also had wildfires and floods, and then labour market industrial action as well. There are also growing concerns that higher rates will heap pressure on household mortgage costs, of course. All sort of along with those cooling inflation numbers, really moving the dial for a rate hike now on Wednesday. As I said, from being a coin toss to only around a 20% chance of that happening. Against that, we have still a labour market which remains strong, jobs being added in August and September, and the unemployment rate still remaining quite low. That means potentially the Bank of Canada will keep the option of a future hike on the table. Governor Macklem really has stressed recently, actually, and probably will continue to stress the importance of wage growth and inflation expectations remaining elevated, although actually many economists believe that interest rates have most probably peaked. Just on dollar CAD, this is really showing that the CAD's technical picture really has still a negative undertone. Dollar trend sort of retains a higher bullish momentum, really, on both the weekly and the daily charts. This is the daily chart. But you can see that the dollar has encountered selling pressure above 137. We do remain shy, obviously, of that early October high, and sort of bearish rejection, really, at 137.85 that high was. So just kind of struggling above 137. Should remain strong resistance, really, but then support, well, we've still got the support at 136.67 here, which you can see has acted as quite a decent level of support resistance. If we do lose that, then probably we're going down to sort of key short-term support around sort of 135.70, 135.80 or so, which is, well, the 50-day moving average at 135.87, and then just below there, 135.70 support. Okay, that's dollar CAD. Otherwise, this week, I should briefly touch upon the US data. We do get third quarter GDP. That looks to probably coming around 4% or so, boosted by strong consumer spending. We highlighted that in the retail sales numbers, leisure and tourism spending being particularly firm, while residential investment should also contribute positively towards government spending. Aside from retail sales as well, we do have, not retail sales, third quarter GDP, that's on Thursday. We do get, as I mentioned at the top of the webinar, the Fed's favored measure of inflation, that's core personal consumer expenditure deflator. Energy prices will lift the headline rate, and probably the core inflation will rise just 0.2% month on month, 3.7%, possibly not as the market expects. Potentially there are upside risks to these numbers. A combination of elevated inflation and strong growth could be, well, just watch out again for that 10-year Treasury yield on the back of that inflation data on Friday. Okay, we'll wrap it up there, as there's a lot we've talked about. Hopefully that's been of use to you guys. I don't see any questions coming through at the moment. But please do follow us on social media, various channels, as well as on the website. We post a daily comment as well, with a chart of the day. So yes, we look forward to speaking to you, not the same time, but on Monday next week. We're back to our regular slot. So hopefully you can join us then. Really good to have you all on the call. And good luck out there. A lot going on. So be safe, and we'll speak to you soon.